The $10 XRP price target is wrong. It's not wrong because XRP is a scam. XRP is not a scam. The price target is not wrong because the thesis is wrong. It is wrong because the input data is contaminated. Every model projecting $10, $50, $100 runs on reported trading volume, scarcity assumptions, and institutional adoption curves. Today, I will take you through each of those and give you a straight answer. The trading volume is partially fabricated. Researchers documented it in a peer-reviewed study. Then the FBI proved it with federal indictments. The scarcity argument ignores 35 billion tokens sitting behind a private company's release schedule, and the Ripple founders were not unclear about the reason Ripple exists. It exists to sell XRP. The institutional adoption everyone is celebrating, the banks, the corridors, the record Ripple quarter, none of it is flowing through XRP. And while all of those things sound damning, and they are, they show you why the models are flawed. The answer I come to on price may surprise you. If you are new here, subscribe. I cover the forensic economics behind crypto. 4 things right now. Let's go. Number 1, how the $10 price target is actually constructed. Then we'll talk about what the volume data really shows us. Then we'll talk about the escrow mechanism and why nobody's modeling it right. And then finally, what the math looks like after you clean all the inputs. Let me show you how the $10 price model actually works, because most people attacking it do not understand it. And if you don't really understand what you're attacking, you're not doing forensic economics or forensic analysis, you're doing FUD. The model starts with a straightforward premise. XRP is designed to function as a bridge currency in cross-border payments. When a bank in the United States wants to send money to a bank in the Philippines, the traditional route runs through correspondent banking. That process takes days and requires pre-funded accounts sitting idle in destination currencies around the world. Ripple's on-demand liquidity product offers an alternative. Convert dollars to XRP on one end, transmit the XRP, convert dollars or XRP to pesos on the other end. The whole thing settles in seconds. No pre-funded accounts, no correspondent banks taking a spread. That is a real problem, and this is a real solution. I want to be really clear about that. The underlying use case is legitimate. The price model flows directly from that premise. If ODL captures a meaningful share of global cross-border payment volume, the demand for XRP as the bridge asset scales with the transaction flow. More volume through ODL means more XRP being bought and sold to settle each transaction. More buying and selling means organic demand. Organic demand at scale drives price. Analysts have pointed to SWIFT's annual transaction volume, which is roughly $150 trillion, as the addressable market. Standard Chartered published a price target for $8 for end 2026 based on ODL capturing 14% of that. Run the math on 14% of $150 trillion moving through a token with roughly 60 billion units in circulation, and the numbers get large quickly. The scarcity argument layers on top of that. Unlike Bitcoin, XRP does not have a mining-based issuance model. The total supply was fixed at 100 billion tokens at inception. Transaction fees are burned, not paid to validators, which means the supply is technically deflationary. Every transaction reduces total supply by a small amount. The bulls argue that rising demand against a shrinking supply is a straightforward price driver. The institutional adoption argument is the third leg in the stool. Major banks are now using Ripple infrastructure. Deutsche Bank, Societe Generale, Aviva Investors. Ripple had its best quarter in company history in Q1 2026. The argument is that the institutional embrace validates the network, creates ongoing demand for the token, and signals the beginning of mainstream adoption at scale. So, the framework is logical. The 3 inputs are volume, scarcity, and institutional demand. Each one tells the same story. XRP should be worth more than it is, and the path to $10 is a matter of adoption catching up to potential. here is where it gets interesting. Every one of those three inputs has a problem, not a small problem, a structural problem. And in economics, when your inputs are wrong, your output is not approximately right. It is exactly wrong in proportion to how contaminated your data is. The pattern I'm about to show you, legitimate technology, inflated adoption narrative, and retail investors holding the bag while insiders exit, is not unique to XRP. It is the central mechanism I document across the entire crypto market in my book, The Token Trap. If you want the full forensic case, the link is in the description. Now, let's go through them. We start with the volume problem because it is the foundation everything else sits on. Every price model that projects $10 or higher uses reported trading volume as a primary input. Volume tells the model how much organic demand exists for XRP. Higher volume means more buyers and sellers transacting at market prices, which means the price is real and the liquidity is real. That is the assumption. Here is what a team of researchers at Cornell, Newcastle University, and Tsinghua University found when they actually tested it. They analyzed 29 cryptocurrency exchanges, 3 of them regulated, 26 unregulated, and applied a forensic statistical technique called Benford's Law. Benford's Law is a well-established tool in forensic accounting. It describes the expected frequency distribution of leading digits in naturally occurring numerical data. Authentic trading follows this distribution. Fabricated trading breaks it because humans and bots generating fake transactions do not replicate the statistical fingerprint of real market behavior. The researchers found that the regulated exchanges looked clean. The unregulated exchanges showed systematic deviation from the expected pattern across every test they ran. Their conclusion, which was published in Management Science, one of the top peer-reviewed journals in economics and finance, on unregulated exchanges, more than 70% of reported volume was fabricated. Wash trading. One party acting as both the buyer and seller to manufacture the appearance of demand. The paper estimated those fabricated volumes amounted to trillions of dollars annually. Now, the XRP community's response to this is usually, XRP trades on regulated exchanges too, Coinbase, Kraken, Bitstamp. The study can't apply to those, which is a fair point, partially. The regulated exchanges in the study showed clean patterns, but here is what their argument misses. XRP's price discovery does not happen exclusively on regulated exchanges. A massive, significant portion of global XRP volume runs through unregulated or lightly regulated venues, particularly in Asia. When wash-traded volume on those exchanges creates artificial price signals, it affects the aggregate volume figures that analysts plug into their models. The models do not filter by exchange type. They take the reported global volume and run the calculation, which means the contamination flows upstream into every price target built on that number. The FBI confirmed that this is not a theoretical problem. In 2024, the FBI launched Operation Token Mirrors. Federal agents created their own cryptocurrency, listed it on exchanges, and both approached and waited for market-making firms to see what services they would provide. What they found was a structured industry. Firms were offering wash trading services for approximately $5,000 per month. They would run fabricated transactions through hundreds of coordinated wallets to generate the appearance of organic trading activity. One executive, in a recorded conversation with an undercover FBI agent, explained that the approach was designed to make the volume look authentic. 10 executives from 4 firms have been indicted. Multiple have already pleaded guilty. The firms operated across Russia, India, Taiwan, and Serbia. The FBI watched the wash trades execute in real time on the blockchain. This is not ancient history. The most recent wave of indictments came down in March 2026. This is happening now, in the market your price model is drawing data from. If you remove the fabricated volume from the price model, the market cap denominator changes, and that changes everything. The $10 price target depends on XRP achieving a market cap of roughly $600 billion. To justify that market cap, the model needs to show that real organic demand at scale will absorb that valuation. The volume figure is the primary evidence for demand. If 70% or more of the reported volume on unregulated exchanges is fabricated, the actual evidence for organic demand is a fraction of what the model assumes. I want to be precise about what I'm saying, and what I'm not saying, more importantly. I am not saying that all XRP volume is fake. I am not saying that the ODL use case generates no real transactions. Some of it is real. The question is how much? And the honest answer is nobody outside of Ripple knows, because the data is not audited, the exchange mix is opaque, and the methodology used in most price predictions does not attempt to filter for wash trading at all. An economist builds models on the best available data. When the best available data is contaminated, the model output is not approximately right. It is precisely wrong in proportion to the contamination. The $10 target is built on a number that has not been cleaned. That is the math problem about the math. Now, let's look at the math problem about supply. Let me show you the second input problem. This one is about supply. And it is, if anything, more damaging to the price model than the volume problem. The XRP community's scarcity argument goes like this. Total supply was fixed at 100 billion tokens at inception. No new XRP can ever be created. Transaction fees are burned permanently, reducing total supply over time. Rising demand against a shrinking supply drives price. That is a coherent economic argument. It is also almost entirely wrong in practice, because here are the actual numbers. Since the XRP ledger launched, the network has burned approximately 14 million XRP in total. That is not per year. That is the cumulative total across the entire history of the ledger. Against a supply of 100 billion tokens, 14 million represents 0.014% of the total supply. To put that in terms that are easier to hold in your head, at the current annual burn rate of roughly 1 million XRP per year, it would take about 10,000 years to burn through just the current circulating supply. Not even the total supply, just circulating supply. The deflationary narrative is not wrong because the mechanism does not exist. The mechanism exists. It is wrong because the scale is irrelevant. The burn factor is a rounding error. Now, here's where this gets interesting. While the network was burning 1 million tokens per year, Ripple was releasing up to 1 billion tokens per month from Escrow. Every month, 1 billion XRP unlocks. Ripple then decides how much to relock in new escrow contracts and how much to release into actual circulation. Their historical pattern runs between 200 and 300 million tokens per month entering the market. Run that ratio. The XRP ledger burns roughly 1 million tokens per year in transaction fees. Ripple releases between 200 and 300 million tokens per month from escrow. The asset the community calls deflationary is being inflated by its own issuer at roughly 200 times the rate things are being burned every month. Let me be precise about what is happening here. This is not a hidden mechanism. Ripple publishes the escrow figures in their quarterly XRP markets reports. The data is on the blockchain. Anyone can verify it. The question is not whether the releases are happening. They are. The question is why the price models treat the escrow system as neutral when it is anything but. Here is the background that you need to understand why this matters so much. In 2012, when the XRP ledger launched, 100 billion XRP were created at inception. Ripple Labs received 80 billion of them. The founders received the other 20 billion. There was no mining, no distribution mechanism, no process by which the tokens were earned or discovered. They were allocated. 80% to the company, 20% to the people who built it. By 2017, the concentration of tokens in Ripple's hands had become a persistent criticism. The community's concern was straightforward. If Ripple controls 80% of total supply, they can sell into any price rally, suppressing appreciation and extracting value from retail holders. Ripple's response was to lock 55 billion XRP into a cryptographic escrow on the XRP ledger itself, with a release schedule of 1 billion tokens per month. The argument was that this created predictability and demonstrated commitment. What it actually created was a structured, company-controlled supply release mechanism with no external oversight, no audit requirement, and no obligation to relock any specific percentage. Ripple decides each month how much to relock and how much to sell, entirely in its own discretion. The escrow system did not remove Ripple's control over supply. It formalized it. And Ripple's own founders were not ambiguous about the reason the company exists. In April 2023, a user on X asserted that XRP sales account for 98% of Ripple's revenue. David Schwartz, Ripple's chief technology officer and one of the original architects of the XRP ledger, responded directly. He confirmed the revenue claim as accurate and then added this, and I am quoting exactly. At least in my view, Ripple was created to distribute XRP as broadly as possible and, with luck and if necessary, to be able to generate enough revenue from sales or things like sales of XRP to sustain its operations. He then noted that the company's only two options regarding the XRP holdings are to sell or to hold. That is the CTO of the company on the record confirming that XRP sales are the primary revenue mechanism for the business and that the alternative to selling is holding. There is no third option where the token appreciates independently of Ripple's decisions about its own treasury. Which brings us to the supply overhang that no price model accounts for correctly. Ripple currently holds approximately 35 billion XRP in escrow and another 4 to 5 billion in direct operational wallets. That is between 35 and 40% of total supply controlled by a single private company with fiduciary duties to its shareholders, operating costs that require revenue, and a stated business model that includes token sales as a funding mechanism. The $10 price target requires a market cap of roughly $600 billion. To reach that, demand must drastically outpace supply, and the supply is not fixed. It is being released on a schedule controlled by the issuer into whatever market conditions exist at the time. If the price rises toward $10, the value of Ripple's remaining escrow rises proportionally. A company sitting on assets worth hundreds of billions of dollars at a higher price with a stated need to sell those assets to fund operations will sell. There is a name for this structure in the token markets I've been watching for 14 years. When an early issuer holds a dominant share of total supply and releases it gradually into a rising market, that is a structured exit. The mechanism is not hidden. It is in the escrow release schedule, visible on the blockchain, documented in Ripple's own quarterly reports. The scarcity thesis assumes the supply is effectively fixed. It is not. It is controlled. Those are not the same thing. Now let me show you the third input problem, the one landed in the market in real time in Q1 2026, and it is the cleanest proof of everything I've been describing. In the first quarter of 2026, Ripple had its best quarter in company history. Revenue tripled. The company hit a valuation of $50 billion. Deutsche Bank, Aviva Investors, and Societe Generale all announced they were using Ripple's infrastructure for cross-border payments and settlement. The headlines were exactly what the XRP army had been waiting for. institutional adoption, major banks, real payment corridors, the thesis playing out. While Ripple the company hit a record high valuation on that extraordinary news, XRP the token dropped more than 30%. That is not a paradox. Once you see the mechanism, it makes complete sense. Here is the question nobody in the XRP community was asking. When Deutsche Bank settles a cross-border payment using Ripple's infrastructure, what assets are they actually selling in? The answer, confirmed by Ripple's own product disclosures, is RLUSD, Ripple's dollar-denominated stablecoin. They're not using XRP. They're using Ripple's payment rails to do it, but they don't need to hold XRP, buy XRP, or touch XRP at any point in the transaction. They use the network, they settle in dollars. The XRP token is optional infrastructure, and the institutions choosing Ripple are, by and large, not choosing the token. This is the structural decoupling that no price model that I've seen accounts for correctly. The ODL thesis, the foundation of every $10 price target, assumes that the adoption of Ripple's network equals demand for XRP. That assumption made total sense in 2018 when XRP was the only settlement asset on the network. But it does not hold in 2026 when Ripple has introduced a stablecoin specifically designed to let banks settle without touching a volatile asset. Think about that from a bank's perspective for a moment. You are a president or a compliance officer at Deutsche Bank. Your job is to move money across borders quickly and cheaply. Ripple offers you two options. Option 1, convert euros to XRP, transmit, convert XRP to the destination currency. You are now exposed to XRP price volatility for the duration of that transaction. Option 2, use RLUSD. Dollar-pegged, stable, no volatility exposure, fully compliant with the regulatory frameworks your legal team understands. Which option do you think the compliance officer chooses? Ripple built the product that banks actually want. That product is not XRP. And the revenue Ripple generates from selling that product flows to XRP's equity holders, not to XRP token holders. The company and the token are legally and structurally decoupled. Ripple's best quarter in company history proved it. The price models that project $10 are built on an adoption curve that assumes Ripple's success and XRP's success are the same thing. The Q1 2026 data shows they are not. So let me give you my answer. XRP's price is not driven by trading volume, scarcity, or usage. The trading volume is mostly fake. The scarcity is a 10,000-year play and is riddled with circulating supply inflation. And the network usage benefits the company, not the token. XRP's price is driven by sentiment. That's not as clear as any of the inputs they give you when they show you charts going to the moon. And the sentiment comes partly from how XRP gets used on the XRP ledger. The XRP ledger is a real network. It processes real transactions. ODL does generate some genuine XRP demand. There are corridors, particularly in Southeast Asia and Latin America, where XRP is still the best active bridge. That demand is real, even if it is smaller than the models assume. But something interesting happens with demand if stablecoins get regulated out of existence or regulated into a position where they make no money for the stablecoin issuer. And something interesting happens if Ripple decides to focus on XRP instead of a stablecoin as that regulatory environment evolves. Now, that's not a price target. That is a variable. And it is, I think, the most important variable in the XRP equation because it is the one Ripple controls, not the market. It is likely the basis of the real model that tells you where XRP goes. Here is what I want to leave you with. I have spent 33 years building financial infrastructure. I have co-founded crypto protocols. I have watched every version of this story. The technology is real. The problem it solves is real, and the gap between what the technology actually does and what the price models assume it will do is where retail investors consistently lose money. The XRP community is not wrong to believe in the network. They are wrong to trust price models built on inputs nobody has cleaned. Fabricated volume, a supply narrative that ignores a 200-to-1 inflation from escrow releases, an institutional adoption story where the institutions are choosing the rails and not the token, and where the company benefits but the token does not. Change the model to a correct one. Then, use those three inputs as secondary indicators where the primary indicators are sentiment driven by, among other things, XRP-specific adoption. I cannot tell you what the number is today because two of the inputs, actual clean volume and Ripple's future product decisions, are not publicly audited. What I can tell you is that anyone who gives you a confident $10 target has not done this work. If you do the work, you get an interesting number. If you don't, you were never the investor, you were their exit liquidity. If you want to understand how this mechanism operates across the entire crypto market, not just XRP, that is what my book is about. The Token Trap documents how the same playbook, inflated volume, controlled supply, and narrative-first pricing, has been used systematically to extract capital from retail investors while the early issuers exit. The link is in the description. Please subscribe if this kind of forensic analysis is useful to you. This is the one place that I think that's connecting the dots in real time. And before you build a position on a price model, ask the one question those models never answer. Where does your volume number come from? I'm Dana Love, PhD. I'll see you in the next one.